Welcome to part 2 of chapter 5. So it actually turns out with these chapters, they do tend to go a little bit faster, but I would pay attention to the homework. Anyways, let's just jump right back into it. So I'm sure you got up, you stretched your legs, you're good to go. Let's talk about supply and marginal cost. So we already went through the marginal benefit side of the demand graph, but let's think about the marginal cost side of the supply graph. One cool thing in economics is that if we have one thing, we tend to have two, right? We have demand and then we have supply. We have marginal benefit and then we have marginal cost. We have consumer surplus, we have producer surplus. There's two sides of every coin, and economics is kind of figuring out what that means. So let's talk about supply. When we're producers, so let's put on our producer thinking hat. Let's assume that we're producing something. Maybe we're the producer. I'm starting to throw stuff everywhere. We're the producer of scrunchies. So firms are in business to make profit. They want to make money. That's just true, right? Why do you produce something? Because you think you're going to get some benefit from it. That benefit tends to be financial. So to make a profit, firms must sell their output. If I'm making scrunchies, it might cost me $10 for the material. It might take me like 5 cents for the elastic. So if that's 15 cents together and then another 5 cents for shipping, that's 20 cents. I need to make at least 20 cents on the scrunchie so I'm not paying for it out of pocket, right? So that I can keep my workers employed, so that I can keep getting, you know, all the factors of production that I need, my land, labor, capital, and entrepreneurship. So I need to make at least 20 cents. Well, there's going to be a difference in between cost and price. It costs me 20 cents to make this, but how much do people actually pay me for it? If people paid me $1 for each scrunchie, but I can produce it for 20 cents, well, then there's going to be a little difference, right? There's going to be a profit that I get in between $1 and 20 cents. Well, this extra little bit of difference, the difference between the price and what I can actually produce it for, the cost that it's costing me, that in between there, that's going to be our producer surplus. So, oops, didn't move forward. So cost is whatever the producer gives up. It's the cost of materials, it's the cost for labor, it's the cost for entrepreneurship, it's the cost for all of our different factors of production that go into making something. The marginal cost is the cost of producing one more. So maybe I can make the first few scrunchies for like 20 cents each. But then after that, like I'm making these in my house, I'm gonna need a bigger sewing machine. My cost is gonna go up. The 21st scrunchie might cost me 25 cents instead of 20 cents. And the 50th scrunchie might cost me 30 cents instead of 29 cents. The cost goes up. That's why we have our increasing supply curve, right? So as price goes up, I want to produce more of it. As price goes down, I produce less of it. A lot of this is also related to the fact that marginal cost happens, right? The more and more and more and more and more I produce of something, the more expensive it kind of becomes to produce. So I need to have a price that gives me money back that's similar to what that cost is for me. So marginal cost is the minimum price I'm willing to accept. If I can buy the material for 10 cents, the elastic for 5 cents, and the shipping for 5 cents, it cost me 20 cents for this scrunchie. The absolute minimum price I'm willing to accept is 20 cents. That's where I break even, where I'm not paying out of pocket or going into a loss, right? Where that break even point, that's my minimum price I'm willing to accept for this. Now, a supply curve is just a collection of all the marginal cost curves. It's a collection of how much can I produce the first scrunchie for versus the 100th scrunchie versus the 1,000th scrunchie. It's looking at the cost that I have associated with that and what I need to be paid in order to still produce that amount. So this supply curve is just going to be the collection of all my minimum prices that are required for each quantity amount. So we have a difference, much like individual demand and market demand, we have individual supply and market supply. Individual supply is the supply of like me, the one firm. If I'm the only person producing scrunchies, then it's my cost related for these scrunchies. Now, I tend to not be the only producer. I bet you can't tell me what company made this actually, Scrunchie's a brand. Never mind. You can't tell me who made this coffee mug, right? There's Pyrex, there's other places. I don't know. I have no idea what coffee mug companies are, but there's a lot of them. So when we start adding up what each supplier is willing to accept, if we start looking at how much they're willing to produce at each price point, Well, then we get the idea of the market supply. The market supply is the collection of how much of the good all producers are willing to supply at each price point. So let's break it into our 3 graphs like we did for the demand side. Let's say we have Maria and Max. Maria and Max are making pizzas, right? Because Dr. Plemmmons loves pizza and will always continue to talk about it. Let's say that Maria, when she's making pizza, she has to sell her pizza for at least $5. So that's going to be where we see the supply line connecting with this y-axis, the price axis, because that's going to be the minimum amount that she needs, because that's going to be how much it costs her in dough and transportation and refrigeration and having a worker. It costs about $5 a pizza. So at $5 she produces none. At $5.01 she starts to produce. At $10 she produces 50. $10 is pretty good, but then her marginal cost goes up. Producing that 51st pizza is more expensive than producing like the 5th or 6th pizza. So as this cost to produce goes up, she has to have a higher price if she's going to produce more of it. So her minimum that she's willing to accept goes up the higher the quantity. So maybe at 100 pizzas, maybe she needs to make $15 to produce 100 pizzas. Or we see the pairs between $20 and $150, $25 and $200. Okay, so that's Maria. Now let's talk about Max. Let's say that Max, maybe he uses a different type of dough. Maybe it's a little bit more expensive. Maybe he has some like tomatoes flown in from around the world or something, so it's more expensive. Okay, so he needs $10 to start producing pizza. That's why we see that that's the intercept on our y-axis, on our price axis. Well, then as we increase in quantity, we need to increase in price, because his the minimum that he's willing to accept, his minimum price is going to go up relative to what his marginal cost is, and marginal cost increases the more quantity we have. So as we increase in quantity, we see that we have this upward sloping supply curve for Max. So we have one for Maria and we have one for Max. So at $15, so let's stay at this $15 point, we go across and we see that Maria is willing to supply 100 pizzas at $15. At $15, Max is willing to supply 50 pizzas at $15. So what does their combined supply look like? I don't know why I make so many versions of this. What is society's supply curve? So we have the individual supply curve of Maria and the individual supply curve of Max, but we need to think about what the market supply curve looks like. And this is just going to be the addition of the two of them. So at $15, we see that we have the 100 pizzas from Maria and the 50 pizzas from Max. So at $15, society is willing to supply their 150th pizza at $15. Now let's break down this whole supply line actually. Well, let's see, we don't start producing pizzas until slightly over $5, right? And that's because that's where Maria is willing to start producing pizzas. So at $5.01, she's willing to start producing pizza. And we see up until the point where there's $10 and Max starts considering production, between these points, we only have Maria producing. After that, we have Max producing as well. We also horizontally sum, much like we did for demand. So for each one of these price points, we go to the price, for example, $15, and then we start to go across. So we'll go across for the 100 pizzas for Maria, and then continue to go across 50 more for Max. This horizontal summation is how we get from these individual supply curves to our market supply curve. So we need to understand the idea of producer surplus. So in consumer surplus, it's the difference between how much I would have been willing to pay and how much I actually paid. The producer surplus is how much I would have been willing to sell it for, what my minimum accepted amount is, the cost of my supplies and material and everything, that minimum amount, and the price that they actually pay me. There's a difference in between this. It's the excess in between the price and what I would have been willing to do it with. So we calculate it as the price received for a good minus the minimum supply price. So let's think about scrunchies. If you paid me $1 for the scrunchie, but it cost me 20 cents to make the scrunchie, then my producer surplus is that additional 80 cents, right? So let me show you what that looks like on a graph. On a graph, it's going to be the difference in between these supply lines and the price line. So let's say our price is $15. If we're making a price line, we go to that level on the y-axis, so in this case $15, and then we draw a straight line across, and we see where it intercepts with supply. Now, the supply line and parts of it are beneath it. That's because the minimum amount I'd be willing to sell it for is less than what the price actually is. So let's shade these ones in blue. So this difference in between the supply line and this price line, these are the producer surplus. That's good. We would like producer surplus too. We like it when there's consumer surplus. We like it when there's producer surplus. Notice that when we add these individual producer surpluses together, we have what our market producer surplus is going to be. So just this amount that's underneath this line. So hold on, there we go. So then we also have the amount that's required to produce a pizza. Remember that we had that block at the bottom that represented our total revenue when it came to the demand side. And this time, we're also going to think about our total cost. So I'm not going to ask you to calculate it, but I am going to ask you to recognize it on a homework question and on a test question. So this difference in between, and I'm going to keep pointing at Maria because there's the largest difference in between it. In between this line, the supply line, and the price, this is our producer surplus. But let's say that it's pizza number 50. So we do have the producer surplus in between $10 and $15. We get $5 of producer surplus for that 50th pizza. But there's also a cost associated. Since this is my minimum that I'm willing to accept, or my minimum price, that means that this is what it costs me. This is the marginal cost for producing that 50th pizza. So it's going to cost me about $10 to make that 50th pizza for Maria. And then I get an additional $5 of producer surplus. We're just splitting that $15. So we need to think about efficiency, right? Because in this one, we're talking about efficiency and we're talking about equity. So let's think about our normal supply and demand graph. We know that demand is our collection of our willingness to pay, right? It's our collection of marginal benefits. So it's our downward sloping demand line. And then we have supply, which is our minimum willingness to accept, our minimum price. It's our upward sloping supply line. And in between, we have this equilibrium point. It's where demand and supply cross. We see that our equilibrium, if we trace it down from this middle point, has a quantity of 10,000 pizzas every day. And if we trace it over to price, we see that we have a price of $15. So let's think about what efficiency would look like in a competitive equilibrium, where supply and demand have this one point. So competitive markets create an efficient allocation of resources at the equilibrium. If we're at the equilibrium, we're efficient. That's because there's just as many people and pizzas coming to the market as there are people willing to come to the market and buy the pizzas, right? So the amount sold is equal to the amount bought at that price point. It's equal to what people are willing to pay, which is also equal to the marginal cost. It's where we're happy. We like being at these efficient points. Now, we have some points where we might have marginal social cost or marginal social benefit that don't necessarily equal in the same way. So let's start with an example. Let's say that maybe we're going to start with a quantity that's less than this equilibrium. So we see that our equilibrium's at an efficient quantity of 10. But let's say we're at 5. Okay, well, if we're producing 5 pizzas, let's start to trace up from 5. What do we see? We see that the marginal social cost, so the amount that it's going to cost me for like one more of something that we're producing as a society, is about $10. So it costs about $10 for that 5,000th pizza. And then if we keep tracing it up, we see that the demand line would be at 20 at this point. So the marginal social benefit, how much society would benefit, is $20 for that 5th pizza. Well, that means that I'm willing to pay $20 for that 5th pizza, and the cost of producing it is $10. Well, at that point, the marginal social benefit exceeds the marginal social cost. People are willing to pay more than what it actually costs to make. Well, what do we do in that situation? We produce more, right? So we start producing more. Okay, well then if we get to that 6th pizza, the benefit's kind of gone down because I'm not willing to pay as much for the 6th pizza as I am the 5th pizza. And we notice that the cost has gone up. It costs me a little bit more to make that 6th pizza than it is 5th pizza. And then we see that the marginal social benefit is above the marginal social cost again. So we're like, oh, let's produce more. And we keep going and going and going until we hit right here at 10 pizzas. So if our marginal social benefit exceeds our marginal social cost, we want to produce more to get to our efficient equilibrium. Now, what if we're on the other side? We see that we are at efficient amount of pizza at 10, but what if we're at 15? Well, let's trace up from the quantity of 15. We go up and we see the demand is at 10. People are willing to pay $10 for the 15,000th pizza. If we keep going up, we see that the supply curve is at $20. So it's going to cost $20 to make the 15,000 pizzas. Well, if we have a cost of $20 and a willingness to pay of $10, well, that doesn't make much sense, right? Because our cost is way more than what people are willing to pay for it. So we're going to reduce the amount. Maybe we go from 15 to 14. Well, our cost for our 14th pizza goes down and our willingness to pay for the 14th pizza goes up, but there's still this disconnect. So we keep going and going and going until we eventually get to our efficient quantity of 10 again. If marginal social cost exceeds marginal social benefit, we're going to want to reduce the amount that we have to get to our equilibrium quantity. Oops. So, is the competitive market efficient? In all of these cases, and honestly, everything that we're going to talk about in the second part of this thing, because we don't go to non-competitive markets until the third portion of the course, but we always assume in competitive markets that resources are used efficiently because marginal social benefit equals marginal social cost at some point, and at that point, we see that there's no more consumer surplus to be gained, there's no more producer surplus to be gained, they're just equal. But that means we've also created these two triangles. Notice that when we go from this equilibrium quantity all the way over to 0, and we look at this price, we've created a triangle there. Now, everything above the price, that's the difference in between what I would have been willing to pay and what I actually paid. So this is the consumer surplus. It's the top part of the triangle. Now, everything beneath it, and this blue triangle, is the producer surplus. It's the difference in between what I'd be willing to accept, what my minimum price is, and the price that you actually paid me. It's the extra bit of good that I get as a producer. So we have our consumer surplus triangle on top, our producer surplus triangle on bottom. When the efficient quantity is produced, total surplus is just this consumer surplus plus this producer surplus. This is maximized. That means if we're at this equilibrium quantity right here, this middle point, this triangle is as big as it can be. We've maximized our total surplus. So let me give you a theory with this. It's the idea of the invisible hand. So in 1776, it was not only important for the Declaration of Independence, it was also important for the Wealth of Nations. The Wealth of Nations is a book that was written by Adam Smith, and he was one of the first economists. He was like one of the founding fathers of economics, because we had economic theory for hundreds of years before them, but we hadn't formalized them and called them what they were and put a graph to it yet, right? So he proposed something. He proposed the idea of an invisible hand, and that people were guided as though guided as in by an invisible hand to get to where resources would be most efficient. That's the idea of if we're right here at 20,000 pizzas and it costs way more to produce the pizzas than people are willing to pay, and then as though guided by an invisible hand, we will eventually reduce the quantity. And we're like, oh, it still costs us more than what people are willing to pay. Let's reduce again. And then you keep reducing until eventually you get to this equilibrium. It works the other way too. Let's say that we're only producing 5 pizzas, but society would like us to produce 10 because it's where surplus is maximized. Well, I don't actively go out there and think, oh, I should buy more pizzas because my benefit is more than the cost, and it's good for society if we increase the total surplus. I don't think about that when I'm in the grocery store, right? Society, though, is guided as though led by an invisible hand to increase that quantity, because at that point, let's think about what happens. If we have 5 pizzas, I go into the store and say, ooh, I'm actually willing to pay a lot for that 5th pizza. And then the people who produce, it costs them just a little bit, right? So they're like, oh, well, our cost is so much below that. We get this nice profit. Then the next person comes in and is like, hold on, there's not a 6th pizza? I'm still willing to pay you a lot. What happens in that case? Well, the producer starts to produce more. And the more and more there is, the 20th pizza or the 9th pizza or the 8th pizza, the less and less benefit we get from the additional pizza. So as though guided by an invisible hand, we'll still come to this equilibrium, this special little point in the middle. And that was just a really cool idea because we hadn't formalized before then that people just doing their own thing, people being self-interested in buying the amount of pizza that they want is actually good for markets because it helps us get to the efficient quantity and the efficient price. If we just let people do what they want to do, So it's kind of interesting. Now we do have the idea of market failures, right? Because this is the idealized world. It's really, really great if I can think for every single good and service that we have exactly the number of people coming to the market to buy as exactly the number of people that want to sell, and that it all works out okay. We don't always achieve this efficient outcome, right? Market failures can sometimes arise when a market delivers an inefficient outcome. An inefficient outcome just means that we're producing too much or too little of something. If society would really like 10 pizzas, but we're only producing 5, well, then we have some sort of inefficiency. There's a market failure occurring. Maybe the efficient quantity is 10, but we actually produce 15 and try to sell them, even though our cost is really high and no one will buy them. Well, then we're producing too much of something. That's a market failure. Market failure means that we're not in this equilibrium point where demand equals supply. Let's think about the idea of underproduction. So let's say that we're producing too little. So let's say in this one, we have 10,000 pizzas is where we want to be, and that's at $15. Well, what if we produce less than that? If we produce 5,000 pizzas, let's go up and see what happens. Well, okay, all right. The producer would have been willing to sell it for 10. The consumer would have been willing to pay 20 for this 5th pizza. If we're not going to this market equilibrium, we're just stuck right here. This is the total quantity that we're producing. What has happened to our triangles? Well, we'll see that our consumer surplus, this green triangle on top, has reduced. It's now a rhombus. It's no longer a triangle. And we see that we have it right here. And then our producer surplus is also reduced. See, gotten a little bit smaller. It's because we just have the part of the triangle that existed up until this line where we stopped producing. Now we have this gray bit right here. These are the trades that society wishes we would produce. We call this deadweight loss, right? It's the underproduction. So our difference in between the 10 pizzas that society really, really wants us to produce versus the 5 pizzas that we're actually producing is the 6th pizza that we're losing out on this consumer and producer surplus on. It's the 7th pizza that we're losing out on consumer and producer surplus on because the pizzas don't exist. This triangle, this is deadweight loss. A deadweight loss just equals the decrease in the total surplus. So it's the decrease in the production surplus plus the decrease in the consumer surplus. This is a social loss. It's bad for society. Society's losing out here. Now that's underproduction. Let's talk about the other case. Let's talk about overproduction, right? So society wants us at 10,000 pizzas, but what if we produce 15,000? Well, if we produce 15,000 pizzas, well, let's go up from there. We notice that people don't want to pay very much for that, and society or producers, it's very expensive for producers. Well, this is too much. This is a deadweight loss that's happening because we're producing things at a high cost that no one's going to buy because they're not willing to pay that cost. That means that there's a triangle of deadweight loss. This is a social loss. How you would find out how that affects total surplus is we have the total surplus from all this consumer and producer surplus. It's the green and blue triangle on the left. Then from that, we would subtract the deadweight loss triangle, so this gray triangle on the right. So we have all the good that were happening for consumer and producer surplus from selling the efficient quantity. But once we start selling over the efficient quantity, we're starting to lose out on the social good. These are bad things happening to us. There's a social loss associated with producing more than what society actually wants. So that's why sometimes we don't produce as much as we can produce because it's actually bad for society. It's not as much as we want, and we lose money on it. So there's a couple sources of market failure. How many slides are in here? Oh, there's still a lot left. Okay. These are big concepts. So I'm going to go ahead and break this into yet another video because I heard some feedback from students that you like the slightly smaller video. So I'm going to try to segment it more often. So go ahead, stand up, drink some water. Water is important for you, and we will get right back to it in a few minutes.